This information that I'm about to give you is what people pay thousands of dollars for in courses to learn how to trade, and I'm going to give it to you for free. And this assumes that you're not a complete beginner and you understand some basics of forex trading, or you understand the foundations of basics or of forex trading. Now, this is volatility 25 index 1 hour time frame recent price action review, and I'm going to use this price action to teach you a very simple approach to catching reversals in the forex markets, whether you're trading the currency pairs, gold or metals or crypto, or you're trading synthetic indices. So this is going to be a very simple approach, step by step. Follow along with me and then you will get it. So 1 hour time frame, I will pull up my relative strength index and then I'll put it in the full screen mode, 4K, and enjoy the lesson. So this model, I use it specifically to catch reversals which are long-term reversals, and I'm going to show you how I'm going to do it. So step number 1 is to identify RSI divergence with price action. Let me write that down. Number 1, identify RSI divergence. So this is a bearish trend. We are looking to catch a reversal to the bullish side as a bullish price action. So I'll anchor this so that we remain in the same point. So now RSI divergence is when price is forming lower lows and RSI is forming lower highs. In this example, we have price forming a lower low like that and RSI forming a lower high like this. So this is a sign that price is likely to reverse. Now for every step, I'm going to explain why we are taking that step. Now whenever we have price forming a divergence with RSI, it is a loss of momentum and it shows that price is likely to reverse. So that is the first signal that price is likely to reverse. The next thing that shows us that price is likely to reverse is whenever you have at this point, or at the formation of this divergence, you have a bullish engulfing candle that gives us this sharp move right here. You can see this bullish engulfing candle. That is the next reason why we want to use a divergence to frame a reversal point. For example, this one here. Now, not all engulfing candles are going to give you reversals. For example, this one here is not. This one is a bullish engulfing candle, but it gives an idea that price might reverse, but you can see price kept going lower and closed below it. So the best thing to do is to get the engulfing candles that give us the divergence on the RSI. What I mean by that is whenever you have a bullish engulfing candle, it could mean you have a short-term reversal but not a long-term reversal. What we are trying to catch is a long-term reversal that gives us higher risk to reward ratio and high win rate. Now the next step is, after you've identified a divergence, you want now price to give us a market structure shift, popularly called as MSS. Others call it change in state of delivery, others call it break of structure, others call it whatever. Yes, so now you can see price was bearish from here to here, all this point here. So at all this price is just forming lower highs and lower lows, and then once it got here, to give us this RSI divergence, and then it gave us a market structure shift like that. A market structure shift is now when in a bearish trend, price closes above the previously formed lower high. You can see this. in a bullish trend, price will form or price will close below the previously formed lower high. So now we have this price closing above the previously formed this is lower high. Yes, okay, those terms tend to confuse me. This is lower high. Yes, lower high. Now when you have price closing above this, or once you have price giving us a market structure shift, that is a second confirmation that price is going to reverse from that point. So this is typical ICT 2022 model. Liquidity sweep right here, and then market structure shift, and then price retracing to this level within this area here. Now, so that is the second confirmation that price is going to go higher, okay, and to give us a long-term reversal or a change in trend. For example, now we are moving from downtrend to an uptrend. Now the next thing is the next step. What is happening? The next step is wait for price to retrace below the market structure shift level and tap into a key area. What are these key areas? We have fair value gaps, inverted fair value gaps, order blocks, breaker blocks. What other areas? For these are mostly ICT terms. You can also have, for advanced price action traders, you can have invalidation level, invalidation zones, which include invalidation X levels. For head and shoulder traders, you can call them the second, wait for price to form the second shoulder like this. So price should reverse to give us the second shoulder. So head and shoulder traders can wait for formation of second shoulder. So this is price reversing to give us a second shoulder, right? So you can see how simple it can be. So let us look at areas of value. Price retraced to give us back into this area. Now we want to look at what areas of value was this price action reacting to. Now you will know that price is reacting to an area of value if it gives us a bullish engulfing candle. For example, you can see we have a bullish engulfing candle right here. So after the formation of this bullish engulfing candle is when you will look at where is it coming from. So when you look towards the left of this price action, you can see we have several areas of value. Let me make this blue. We have you have this fair value gap here. You can see price tapped into it. You have this inverted fair value gap, which is in the same area as this fair value gap. Price tapped into it. We also have did price come to this order block? We can say, yeah, let's see this is an order block, and also this one is here is an order block, a bullish order block. You can see price tapped into it. Now for Malaysian support and resistance traders, this is a rejection block. So rejection block, price taps into that rejection block with an engulfing candle to give us an idea that price is going to go higher. Advanced price action traders, you have an invalidation level here, right? So this invalidation level is price where price tapped into here and gave us this bullish engulfing candle. So you can see almost all the models are represented in this setup. All of them are represented in this setup. So ICT, this is ICT 2022 model. Again, the same thing. ICT 2022 model is just doing the same thing. CRT traders, those who love CRT, you can see that CR high, CR low, and you have price sweeping this liquidity and going up to give this to come to this level here. So that is another setup someone would have taken, right? And then what else? Yeah, so almost all the setups are represented here. The next thing now we want to see is, you see now price has reacted off an area of value like this with a bullish engulfing candle. You see, like this. So this bullish engulfing candle again is giving us the idea that price is going to reverse from this level. Now this bullish engulfing candle is the one that we will use to frame a trade. If you are in the higher time frames, you can wait for price to retrace to the midpoint and go higher, or go to the lower time frames and frame an entry around it, an entry around this engulfing candle. So you just look for a repetition of the same model. So this is the 1 hour time frame. You can go drop the 5-minute time frame to look for entries or to find an entry. Alternatively is just to pick a buy setup here at the close of that engulfing candle, stop loss below this engulfing pattern. You can see where it is, engulfing pattern. If you are a conservative trader, you can place your stop loss below this protected low here, but we are trying to minimize risk. And then now you can see this is a long-term reversal, not a short-term reversal. You can see that. And now once you have that, you can have a fixed risk to reward ratio of maybe even 4R like that, or 5R like that, or use the market structure to get the final take profit. So this would have been the final take profit for this trade. Now so that is step number 3. Step number 4, we've already gone through it. Once price reacts, wait for price to retrace below the market structure shift level and tap into a key area. Once price reacts of a key area with an engulfing candle, frame your entries around the engulfing pattern. So that is how you frame those entries. So framing the entries is just taking an entry at the close of this engulfing candle, stop loss below the engulfing candle, take profit fixed 4R, 5R, or based on market structure, where you have this formation of highs or high highs like this. So that is the entire trading setup anyone can use. You don't have to pay $3,000 to learn these things, not $1,000 to learn these things, 500 to learn these things. So unless you are a complete beginner and you want to shorten your learning curve, if you want to shorten your learning curve, it's now when you look for a trading mentor, teacher to teach you. Na kama make a bay, you pay that mentor because they have suffered, they have learned through sweat and tears, and it is a high time people pay for value. And when you're paying for value, make sure you get the value you deserve. So that is the entire trading model presented to you in how many minutes? Are they 10? 15 minutes. Oh my goodness. Yeah, so 15 minutes. So step number 5, take your profits, withdraw, and enjoy life because you deserve it. That is it. Bye bye.